Hello, welcome back. So in today's video, I'll be revealing my full watch list in my stock portfolio today. So in today's video, we'll be covering a few things. We'll be covering the metrics that I look out for when it comes to investing, my watch list, as well as some questions that you guys have left me in the comment section below. So let's talk about the metrics that I look out for when it comes to investing first. So the first metric is ROIC, return on invested capital. Typically for ROIC, I want it to be above 15% in most cases. ROIC measures return on investments, and the greater the returns, the greater quality the business is. Next metric is high margins. Typically when you're owning stocks, you want stocks with high margin because it signals a greater degree of pricing power. So besides high margin, I also want companies to be able to maintain their margins or improve their margins over time as well, which signals a strengthening of the moat of the business. Next metric is your EPS growth as well as your revenue growth. So the company must have a strong runway of growth, and there must be secular growth trends for this company as well, which includes your consumerism, increasing birth rate, increasing debt market, or AI adoption. All these different secular trends, they are what you should be looking out for when it comes to investing in stocks today. Last metric is sound capital allocation. So I want minimal share dilution, minimal stock-based comp, and management needs to do buybacks and give back cash to shareholders through dividends as well, because that's the best way for them to minimize their losses and their mistakes. So management and shareholder must be aligned in order for the investment to work, and that is how I feel about all my companies. I want my companies with management with sound capital allocation skills to buy back the shares or to just give it back as dividends. So let's talk about some of the companies on my watch list today. The first company on my watch list is FICO, Fair Isaac. This company is down 11% year to date, currently trading at a 76 times earnings. So for Fair Isaac, it is in the consumer credit rating portion. It is sort of like in a monopoly already. The closest competitor to this business is VantageScore, but VantageScore is simply not gaining the traction that FICO is able to. So for FICO, the metrics are just incredible. You have 55% ROIC, you have 80% gross margins, you have buybacks from the company as well, and then you have 20% EPS growth over the past 10 years. In fact, even in recent years, despite the mortgage market slowdown, this company still has been able to achieve a 20% EPS growth for those periods. So this company is an extremely durable one in terms of the fundamentals. I think the fundamentals are one of the best looking ones out there out of all your different companies in your S&P 500. So for FICO, this is why I haven't bought into the stock. The company is simply too overvalued. The stock is trading at a 76 times earnings today, and you have to assume a 20% EPS growth over the next 10 years for this to work out. So I'll be interested at $1,400 a share, and hopefully Bill Putte, the director of your FHFA, comes back again and talks about FICO. That is when the stock will start to drop again. And I don't think I'll be interested in FICO today at its current price. The current price today is just simply too overvalued. Next stock that's on my watch list is Alibaba. So Alibaba year to date is up around 40%, currently trading at a 15 times earnings. So for Alibaba, why am I interested in this company? So Alibaba is China's biggest retail giant in the online space with 42% of the online retail market. Baba is also China's leading AI company with 25% of the market share in the cloud space. So you have the China stimulus money that is going to come in to boost the consumer spending, which hasn't even taken into effect yet. And if you're to account for that on top of the AI growth that Baba is about to have, then this company will likely be able to generate alpha above the markets for the next few years. So for Alibaba, this is my problem with the business. So Alibaba has poor metrics and the track record hasn't been the greatest. So Baba is going on a capex spending spree right now, and the last time they did it in 2022, the ROIC dropped from around 15% to 6%. So their capital allocation skills from 2022 wasn't the best, and currently now they're going into the same trend as well, where they start spending a lot of money and start putting money into capital expenditure, and that could be a problem for this business in the future. Alibaba is at risk of government's actions as well, but China are now emerging from a housing crisis, so I don't expect the government to interfere too much into the tech space, especially in the Chinese tech space. So for Alibaba, when will I be interested? My fair value for Alibaba is at around $130 to $140, and I want a big margin of safety for this one simply because of the risk associated with the government itself. So I will look to enter between $100 and $110 a share. It's a retail recovery play with some AI tailwinds behind it. So it's a recovery play betting on the fact that your consumers in China will start improving. There's another company in the retail segment which I'm quite interested in as well. It's LVMH. So LVMH, the reason the company hasn't been able to grow over the past few years is because of your China slowdown. And betting on LVMH is similar to betting on Baba, where I bet on the Chinese consumer recovery. So LVMH is another one that is quite interesting on top of Alibaba over here. Let's see how those two play out. So the next stock that I'm interested in as well is OTIS. So this company is trading at a 25 times earnings, and year to date is up around 3%. So for OTIS, what do? They sell all your different elevators. So your elevators that you see in your malls and so on, they are likely to be manufactured and developed by this company called OTIS. OTIS is one of the leading elevator companies in the entire world. So why am I interested in this company? This company is the largest company in the lift segment, about 20% of the entire market share. It has 20% ROIC. It has an installed base with 2.4 million units being serviced with recurring revenue, and that installed base will continually grow as well with new lifts coming in as well. So for OTIS, why has the growth slowed? So in China accounts for around 60% of the global lifts payments, and currently now China's housing crash is causing lower demand for your lifts. So when that portion of the business recovers, then you will likely see OTIS recovering and returning back to growth. The growth in their maintenance portion is only about 3 to 5%, with 2% in elevator sales. So you can expect around a 5% revenue growth for OTIS, and improving margins as well could bring that up to around 8 to 10%. So for OTIS is a high quality business with a stream of recurring revenue that is highly predictable. If I can catch this at a very good price, it will likely give me market beating returns. Currently, it's trading at around 25 times earnings. I'm not too interested in the stock at 25 times earnings. So I'll be interested at close to around 20 times earnings when it goes back to one of its lowest points in terms of its valuation itself. So for OTIS, I think it's a high quality business. It's quite an interesting one. And if you're interested in a recurring revenue business like OTIS, then this could be one that is interesting. The next company that I'm interested in buying as well is Pool Corp. So Pool Corp year to date is down around 10%. Currently it's trading at around 27 times earnings. So for Pool Corp, this is their business. So they basically sell pools. They sell everything related to your pools. So from your pool pumps to your chlorine in your pools to the actual maintenance for your pools, they do everything for that. And for Pool Corp, 61% of their revenue is non-discretionary, meaning to say it is related to your maintenance of your pools and all that. And then the remaining 40% of their revenue is discretionary. So the 60% is sort of like recurring revenue business where they have pools that require equipment to basically maintain. So for Pool Corp, this is the wonders of the business. They have the pools that are currently now present. So that's their installed base already. So they can continually go and service the pool and get a recurring revenue for that portion. They can sell equipment for the maintenance of those pools. And then on top of that, every single year you have new pools coming in as well. So it is an increasing installed base that Pool Corp can basically exploit to make more money. And that is why you're seeing Warren Buffett buy into this stock. So for Pool Corp, this is why I haven't bought into the stock yet. Pool Corp is overvalued at current price. I'll need the stock to drop to around 20 times earnings for me to be interested. It's a high quality business that Buffett clearly likes, but not for me yet unless it gets to the right price. So for Pool Corp in the recent years, the revenue has been dropping. So for 3 years in a row right now, the revenue has dropped. Why? Because after COVID, everyone spent their stimulus money on pools, and that was when you saw the large spike over here. And now the revenue is normalizing. So for Pool Corp in the next few years, I don't expect the revenue to be growing at 10-15%. It will likely grow in the single digits, if so. And for Pool Corp, the ROIC wise, it is a company with incredible ROIC as well. So typically for S&P 500 companies, they have ROIC of around 8%, but Pool Corp, it has an ROIC of around 16%. So for a retail company with such a high ROIC, it's actually quite incredible. And that's why I'm interested in this one. Last stock, I already own this stock, but this company is Amazon. So Amazon year to date is still down around 3%. It's currently trading at a 34 times earnings. And for Amazon, I think it's just a quality business that will be unaffected by all your tariffs. So the tariffs that happened was simply just too overblown. And at that point, Amazon dropped to around 180, even to around $160 a share. Currently now it's trading at a $212 a share. And at its current price, I still think that you can achieve alpha above the market. And that's why I'm still looking to deploy money into Amazon if it drops to around a decent price. So my next entry for Amazon, if so, will be around $190 a share. So for Amazon, if you're to look into the advertising business, for example, they're increasing their margins like crazy for that one. And you can expect them to continually do so over the next few years. So Amazon is simply just an incredible business. It's one of the most underrated Max 7 companies out there. It is currently trading at one of its lowest ever valuation, at 34 times earnings. So for Amazon, I'm still waiting for this one. My fair value for Amazon is around $200 a share. Currently, it's slightly above that. So I would like for it to drop below my fair value for me to start entering into this stock again. So last portion, I'll be talking about some questions that you guys have left me in the comment section. So the first one is on Lululemon. Can you evaluate Lululemon, please? Yes, I'll do it. So for Lululemon, the stock today is down around 20%. It's currently trading at an 18 times earnings and it's close to its 52-week low. So Lululemon, it actually beat earnings. In fact, the earnings were quite decent. So the revenue came in at 2.37 versus 2.36 billion expected. The earnings per share came in at $2.6 as compared to $2.58 expected. So why exactly is the company down? The company is down because it cut its full year guidance. So it expects its full year guidance to be between 14.58 to 14.78 EPS per share. Previously, it expected full year earnings per share to be in the range of 14.95 to 15.15 for the year. So analysts anticipated around $14.89 of EPS, and Lululemon's guidance came in a lot lesser than expected. So when a company lowers guidance, it could be due to a few things. It could be because the management is trying to lower expectations so that they can go and beat it. Or the other aspect is simply just the macroeconomic conditions are not very good, and that's why Lululemon is lowering their guidance. So I actually looked into their earnings. Their comparable sales in US is actually down. So US is clearly not their growth path anymore. The growth path is in China. China had around 20% growth. So I expect that segment to continually grow as well. So for Lululemon, this is my problem with the business. The business is simply operating in a region or segment that is simply too saturated. So there's a lot of competitors in this space, and currently Lululemon holds around 5% market share in the entire apparel industry. So you have a lot of different apparel companies in this space. You have Nike, you have Alo, or you have different other emerging sportwear companies that are coming up as well. So for Lululemon, I don't see the competitive advantage in this one. And normally for your retail stocks, you don't want to buy retail stocks that are fast fashion, because for fast fashion retail stocks, they normally come and go very fast. So they'll have a fad where everyone is hyping up the clothing, and then a few years down the road, the hype will start to die. And then when the hype starts to die, that's when you see the fundamentals start to slow as well. So I don't expect Lululemon's earnings to turn anytime soon. In fact, the earning metrics are quite amazing. But for me, I don't think this company is predictable enough for me to hold for the next 5, let alone 10 years. So for me, Lululemon is an avoid, similar to companies like Deckers, Crocs, Abercrombie & Fitch, Ralph Lauren as well. All these different retail companies, all these different retail apparel as well as footwear companies that typically avoid because they have too much competition in the space. Next stock is Docusign. So this comment over here, it says, hey Guan, Docusign just crashed even though it beat its Q1 earnings. It's trading at a pretty nice valuation now. What do you think of the company? So for Docusign, the stock is currently down 15% year to date, currently trading at a low valuation of around 15 times earnings. So for Docusign, this is the business. Their business is simply just to sign PDFs, to sign documents. And for me at least, I don't think there's a competitive advantage in that, especially with all these different resources online. So for Docusign, I don't think they provide a proprietary software. Maybe they can sell their products at a very low price to attract volume. But I see a lot of competition in the space. So you have Adobe with their document signing as well. And then you have all these free platforms as well. So for Docusign, I think it's a company that is decently priced, 15 times earnings. But for me, I don't think the company has any sort of economic advantage or competitive advantage. And that's why I don't think I'll be investing into this one. I hope you guys have found this one useful and invest.